Yes, evening. And today I think we are going to discuss on financial management. And under financial management, today we are going to do a small briefing about what we are supposed to cover in intermediate level, that is financial management. That is what we will be discussing for the lesson for today. And I have shared the syllabus. I've shared the syllabus with us, and I think the financial management syllabus is in page 41 to page 45. Page 41 to page 45. That is what we will be trying to highlight for today, so that we can see what we are supposed to cover before the end of the lesson. Not the lesson, but the end of the semester. So under this financial management, one thing that you should be able to understand is that you as the runner, you need to be able to explain nature and scope of what we call the financial management. Other than that, you need to know how to describe the nature and the functions of the financial institutions and markets. Also, we have analyze the sources of finance for an organization and evaluate various financing options. Also, we are supposed to look at evaluate the what we call the you evaluate various investment decision scenarios available to an organization, and also you need to know how to evaluate the performance of a firm using the relevant financial tools, making appropriate capital structure decisions for a firm, then value financial assets and firms also make the appropriate capital structure decisions to a firm. Also, you are supposed to value what we call, you are supposed to value. Also, you are supposed to, you are supposed to, I've said that we are supposed to make appropriate capital structure decisions for a firm, value financial assets and the firm, also make appropriate liquidity and dividend decision for a firm. Notwithstanding, evaluate the current development in the field of finance and their impact on financial decision. Once you are able to understand those key areas, you as a runner, for you to tackle this area, it becomes very, very, very easy for you. What are some of the topics which are covered in financial management? Some of the topics which are covered in financial management, one of the topics is the introduction of financial management, what we refer as the overview of financial management. And when we talk about the overview of financial management, in this case, we are going to look at the theoretical framework of financial management, where we look at the roles and the responsibility of a finance manager toward the shareholders, employees, society, government, and other stakeholders. Also, we look at the goals of the firm and what we call the corporate strategies. What are some of the goals of the firm? We have financial goals, and also we have the non-financial goals, or sometimes we refer as the objectives of the firm. So in this case, where we look at, for example, when we'll be looking at the objective, that is the financial goals, we are going to look at what we call the profit maximization, wealth maximization, Then we can look at, for example, also leverage, etc., etc. Then for the case of non-financial, how do these organizations, for example, assist the society, the growth, etc., and etc. Other than that, we will be looking at what we call the overlapping and conflict among the objectives. Sometimes you find that there is a conflict between uh, what we call there is overlaps and conflict among the objectives. So we should be able to describe that into details. Notwithstanding, we look at the agency theory. Also, we have the stakeholders theory and what we call the corporate governance. Here is where we are going to look at the agency relationship between, for example, we can talk about the shareholders and the management. We can talk about the debt holders and versus the shareholders. Then we can talk about the shareholders versus, for example, the government. And also, notwithstanding, we can talk about the shareholders, for example, versus the auditors. What is their relationship, and what are some of the conflicts, and how can you try as much as possible to be able to solve those conflicts. And finally, not finally, also we will be discussing on the measuring managerial performance, where we talk about the compensation and incentives, and notwithstanding the ethical issues in financial management. Those are the areas that we should be highlighting under the introduction, or what we refer as the overview of financial management. Then another topic that we will be covering is what we call the financing decisions. Financing decisions, this is whereby you come up with the ways in which you are going to finance an organization. So how do you finance an organization in this case? For example, let us say you have a company and then you want to look for the funds. How are you going to get these funds which will help you to carry out the business? That is what we call the financing decision. So here we will be looking at the nature and objectives of the financing decision. Also, we are going to look at what we call the factors to consider when making a financing decision, sources of finance for enterprise. Remember, in this case, we have internally generated funds and externally generated funds. Long-term sources, like we have the equity, debt, hybrid, we have risk finance, venture capital, business, angels finance, we have the private equity, asset secularization, and we have the sales. Also, we look at the Islamic finance and the initial coin offers. Then medium-term sources, such as we have the medium-term loans, higher purchase financing, and short-term sources of finance, such as what we call the overdraft finance, trade, credit, issue of the commercial papers, accruals, deferred income, and their characteristics of each source of finance, what we call also the advantages and the disadvantages. Or in other words, we talk about the pros and cons of various sources of finance. When we talk about the pros and cons, is like when we are talking about the advantages and disadvantages in this case. Other than that, we look at the evaluation of financing options, methods of issuing ordinary shares. We have the public issue, private placement, bonus issue, employee stock option plan, ESOPs, and what we call the right issues in this case. So that's about the second topic under financial management. Also, we'll be looking at the financial institutions and the markets. And these financial institutions and the market, we'll be looking at the overview of financial systems, where we have the financial markets, financial institutions and financial instruments. Also, we will be talking about the nature and the roles of financial markets. We have the primary and secondary security markets, money and the capital markets, over the counter and organized markets, derivative markets, then we have mortgage market and forex market. These are going to be discussed in the topic number 3. Then we talk about the Nairobi Stock Exchange, what we refer as NSE, of NSE or equivalent entity in other jurisdiction. So in our jurisdiction, that is Kenya, here we will be talking about NSC, Nairobi Security Exchange. So the roles and the functions of the security exchange terminologies. We'll be looking at the security exchange risks, listing, and cross-border listing, share indices, timing of what we call the investment at the securities exchange. We have the central depository system and automated trading system. And also we have the mutualization. Then we have the stock market indices, central depository systems, and automated trading system, timing of investment at the security exchange. We have Doe theory and Hatch system of timing. The financial institution and intermediaries, where we'll be talking about the commercial banks, savings and loans, associations, and the cooperative societies, foreign exchange bill, unit trust, and mutual funds, insurance companies, and pension firms. Also, we have the insurance agencies and brokerage firms. Then investment companies, investment banks, and stock brokerage firms. Then we have the microfinance institutions and the small and medium enterprises, what we refer as SMEs in this case. That is also what we'll be discussing. Notwithstanding, we will also be looking at what we call the regulation of financial markets, where we have the Central Bank of Kenya, what we refer as the CBK. CBK is the one that regulates the financial institutions in this company, like commercial banks, or also we'll be looking at the equivalent entities in other jurisdictions. We need to know the roles of the central banks and the monetary policy of central bank, capital market authority, and the insurance regulatory authority, factors responsible for the rapid development of financial institutions and the market. And finally, in this topic, we look at risks facing the financial institution. Remember also the risks. We need to see how can we minimize the risk, or how can we make the risk as minimal as possible. Other than that, the topic number 4 will be the time value of money. And when we talk about the time value of money, this is where you find that in most cases, we'll be talking about a shilling that you have today is more valuable compared to a shilling that you are going to have tomorrow. Why? Because as the time goes by, in this case, you will find that the purchasing power of that 1 shilling is going to go down. And therefore, that is why, in this case, you will find that it is advisable to invest today rather than investing the same currency in the future. So therefore, in this case, when we are talking about the time value of money, we will be looking at the concept of time value of money. We look at the relevance of the concept of time value of money in financial management, time value of money versus the time preference of money. So whereby in this case, in most cases, we'll be saying that why do you find that the individual prefer to have the cash today rather than having the same cash in future? Some of the reasons that you will find why the individuals prefer to have the cash today rather than having the same cash in future is that, for example, you will find that there is availability of a discount. For example, if there is a discount which is being offered for maybe if you want to purchase a particular item, in this case, and you have some cash, then you will use that money to purchase that item at a discount. So that is one way of the reason why all of us prefer to have the cash today, for example, rather than having the same cash in future. Another reason why we will prefer to have the cash today rather than having the cash in future is because of what we call the future uncertainties. We are not sure of what is awaiting us in the future. So therefore, it is good for us to have the cash today rather than waiting and having the same cash in future. Also, other than that, we can talk about different different reasons why individuals want to have the cash today. You have your own interest why you need to have the cash today. For example, you want to spend that cash to buy something. Those are some of the reasons that we will be discussing under the time value of money. Then from there, we look at the timeline, real versus what we call nominal cash flows, compounding techniques, compounding interest, where we talk about the future value. So the future value, this is where you take the present value, then you compound it so that you can get the future value. For example, if, for example, you have 100 shillings today, and then you want to find that in future, that amount will be how much. So we will be looking on how are we going to calculate the future value from the present value. Notwithstanding, also we will be looking at how do we get the present value from the future value, or what we call the cash flow estimates. So uh, when we talk about the future value will be calculated through what we call the compounding. When we are getting the present value, will be calculated from what we call discounting. We are going to discount the cash flows in this case. Also, we look at the loan amortization and what we call the sinking funds. So the loan amortization, this is where, for example, you borrow a loan in a financial institution. Then how are you going to amortize that loan? So we normally prepare what we call the amortization schedule. Amortization schedule, whereby in this case, it will help you to see how much is the installment, how much is the interest that you are going to pay, for example, monthly, yearly, depending on the timeline. Then we will be looking at the principal amount and the balance. And for example, if you have gotten a loan for 3 years, you are going to pay this loan for 3 years, then you need to prepare the loan amortization schedule so that you can see how much the interest are you going to pay every month, and also how much the interest are you going to pay every year. And also it can help you to see how the amount is reducing as the time goes by. Then that's about the topic number 4. The topic number 5, we are going to discuss about the business. Then we have the financial asset valuation models. Under this case, under the business or financial asset valuation models, in this case, we'll be looking at the concept of value, where we'll be looking at the book value, going concern value. We have the substitution value, replacement value, conversion value, liquidation value, intrinsic value, and the market value. Then from there, we look at the reasons for valuing the financial assets. Why do we value the financial asset in this case? Number one, you value the financial asset in case you want to sell those financial assets. So if you want to sell the financial assets, therefore it is important for you to value them so that you can see how much are you going to get from the selling of those financial assets, or how much can you sell those financial assets. That is why, for example, the government you find that the government wanted to sell the government is in need. They want to sell the shares that they own in Safaricom, 15% that they are talking about. In this case, they need to value those shares and find how much are they worth. Then from